right, let's go on with our class. Like I said, I think last week, when you are getting towards the end of the class, some students will decide on their own to stop class. However, we have a responsibility to take the class to the final point. We are looking at question on, all right, for that, there was a noise on the background. I wouldn't know why, but please check your speaker so as to avoid external interference. Please confirm you can hear me clearly.
Confirm, sir.
All right, let's go on. Last week, we discussed interest rate risk management. We looked at the risk involved in interest rate fluctuation. When a company borrows money, when a company borrows money, definitely you are going to pay interest on your borrowing. A company can decide to borrow at a fixed rate, or you can decide to borrow at a floating rate. When you borrow at a floating rate, your interest payments, the interest payments you are going to make yearly, you are not sure, because the rate is not fixed. Because this rate is subject to fluctuation, that creates risk. You may equally ask yourself that, why will a company decide to borrow at a floating rate? At times, the floating rate, a company may have a favorable advantage borrowing at a floating rate. A company may have advantage by borrowing at a floating rate because the company's credit rating may favor floating rates. Then when you borrow at a floating rate, there's element of risk. Your interest payment is not certain every year. Your interest payments may move. Anthony, please, can you mute? Your interest payments may move up or down. If you move up, you pay more. If you move down, you pay less. That creates uncertainty for the business. Another problem of risk from interest rate is when a company is planning to borrow money. When a company is planning to borrow money at a future period, assuming you are borrowing money now, You know the interest rate that you are going to pay now. But you are planning to borrow money at a future specified date. What the interest rate will be at that future period, you are not sure. That uncertainty creates risk for the business. We explained this last week. We now explained method of hedging interest rate risk. We explained smoothing, pooling of assets and liabilities. We explained forward rate agreements. Whereby you can go into, a company can go into forward rate agreements with a view to fixing the interest rate payable or receivable on a particular loan or deposit. Once the rate is fixed, that rate becomes binding. We explained that the borrower will buy francs, while the lender will sell francs. And we explained that francs are variously described. You can have 3 to 9, 3 versus 9, 3 multiplied by 9. We explained this last week. We equally looked at the interest rate futures, a financial derivative contract with interest rates bearing assets, bearing instruments as an underlying asset. Futures contracts can be used to hedge against fluctuation in interest rates. By using the inverse relationship between interest rates and bond value. We can hedge by using the inverse relationship between the interest rates and the bond value. We explained that under futures, 2 transactions are involved. The actual borrowing and lending in the money market, and the hedging of the interest rates in the futures market. These 2 markets are designed in opposite direction. We explained this last week. We equally discuss interest rate guarantees. Interest rate guarantees are short-term interest rate options that can be used to guarantee the maximum interest paid or the minimum interest receivable. This guarantee will only be used if it is favorable. If the guarantee is not favorable, the company can take advantage of market interest rates that is favorable. However, interest rate guarantees involve the payment of premium. We equally explain options on interest rate futures. These are options to buy or sell futures on interest rates. Hence, all the peculiarity of interest rate futures are still valid under options on interest rate futures. What are these peculiarities? We have standardized contract size. Options on interest rate futures are standardized. The contract must be whole number. You cannot do fraction. All contracts are for 3 months. March, June, September, December. A potential borrower sell futures in the futures market or buy put options in the option market. A potential lender buy futures in the futures market or buy call option in the option market. We explained this and the steps. We rounded up the class with interest rate swap. Interest rate swap is an agreement between two counterparties to exchange interest rate obligation, to swap interest rate obligation. The two parties agree to swap interest rate obligation. When we get to question, we are going to dwell more on this. Last week, we cannot attend to any question. Of course, because of time. Tonight, our focus will be on question, and the question will be used to further explain what we have discussed. Let us start with question 1. Please refer to your study pack. I'm not sure of the page. I think page 146. Katangwa Limited. Please, can somebody confirm the page if you are there? Oh, page 133. All right, thank you, sir. Please, let's check page 133. Question number 1. Katangwa Limited. We are good to go. Let me expand this. All right. Katanga Limited, we need to borrow 50 million naira in 3 months' time for a period of 6 months. The company is concerned that interest rates are expected to rise over the next few months. interest rates and forward rate agreements are currently quoted as follows. The spot interest rate, assuming you are borrowing money now, the rate is between 5.75 to 5.50. You have 3 to 6 francs and 3 to 9 francs. Requirement A. Explain how forward rate agreements may be useful to the company. Illustrating this on the basis that interest rates rise to 6.5% or 4 to 4.5%. All right. We are to explain how FRA agreements can be useful to Katangwa. Now, before the explanation, our company wants to borrow money in 3 months' time for a period of 6 months. And we want to use FRA. Which of the FRA are we going to use? 3 to 6 or 3 to 9? Any opinion from the students?
3 to 9.
3 to 9. Thank you. The appropriate FRA is 3 to 9. That's correct. Now, we are given 2 rates. Are we going to pick 5.49 or 5.64? Are we picking 5.94 or 5.64? Which of these rates are we going to pick? To answer this question, our company is planning to borrow money. As a borrower, we are going to buy FRA. Please listen to this. As a borrower, we are going to buy FRA. That means the bank will sell FRA. Our company is the buyer of FRA because the borrower will buy FRA. Then the bank will sell FRA. At what rate will the bank sell? Bank will sell at the higher rate. The higher rate is 5.94%. Is that explanation clear? Or do anybody require clarification? Okay. So I can assume that the explanation is clear. Now let's go to the explanation. Look at it. What you are expected to write first. Entry into FRA. That is entry into a forward rate agreement. We allow the company to effectively lock in an interest rate for a specified future period. Here, for a 6-month period, starting in 3 months' time, ending in 9 months' time. That is, we are going to use 3 to 9 francs, which will lock us into a borrowing rate of 5.94%. The franc is independent of the loan itself, upon which the prevailing rate must be paid. That franc is an independent instrument. On the actual borrowing dates, the company will pay the prevailing interest rates on that actual borrowing date. You are going to go to bank, like we explained. You can go to First Bank to enter into franc agreements. On the actual borrowing date, you can approach Guarantee Bank or Zenith Bank to borrow your money. Zenith Bank is not aware you have entered into franc. You are going to borrow at the prevailing interest rates. However, any differences between the actual borrowing rates and the franc rates will result in cash flow from the franc that offsets the higher or the lower interest rate, the lower interest cost. Let us demonstrate this with supporting calculation. Let us demonstrate this with supporting computation. Please, 1 minute. Allow me to take water, please. All right, thank you. Let us demonstrate this. You come here, you have your table. You are given 2 scenarios. Scenario 1, scenario 2. Start with your actual borrowing rates. Examiner says interest rate rise to 6.5 or 4 to 4.5. Actual interest rate on the borrowing date happens to be 6.50% or 4.50%. Your franc rates, 5.94%. Let's take this approach so that let us start with the franc rates so that we can reduce interpretation error. Our FRA rates 5.94%, 5.94%. Actual borrowing rates 6.5%, 4.5%. If scenario 1 should happen, you borrow at 6.5. That means you have incurred loss because you are borrowing at a rate above what you plan. The difference, please. Your plan is to borrow at 5.94%. You are borrowing at 6.5%. That means you are borrowing at an higher rate above the FRA. The difference. Please compute and give me this figure. 0. What? Negative.
5.6.
0.56%. Second scenario, you have agreed to borrow as, that's positive. You agreed to borrow at 5.94%. On the actual borrowing date, you borrow at 4.5%. That means you have achieved a gain. Is that not, please? You now come here. Your actual interest cost. The actual interest cost. For scenario 1, let's go down and do the working. Okay, we have to create space. Okay, let me do it here. Scenario 1. For scenario 1, 6.5%. We are going to borrow 50 million for 6 months. Please work this out. What is the actual interest cost under scenario 1? Scenario 2, you borrow at 4.5. You are going to borrow 50 million for 6 months. What is the actual borrowing cost? Please compute.
Scenario 1, 162,500.
1 million
No, it should be 1.6 million.
1,065,000.
1 million
5,000, yes.
That is your actual borrowing cost. Scenario 2, your actual borrowing cost, please compute. 1 million.
1,125,000.
Now, the difference. Here we need to reduce this amount by 0.56%. We call it compensation received or paid. Received or paid. For the first one, I have incurred loss. I must receive back my loss. Let us shift down a bit. That will give me compensation received. Because I'm supposed to pay 5.94%. I paid 6.5%. Then I must get compensation for this payment. Look at it here. For scenario 1, 0.56% of 50 million for 6 months. That will be compensation you are going to receive, so as to reduce the amount you have paid. Please compute. For scenario 2, 1.44% of 50 million multiplied by for 6 months. Please compute this. Please, let's go on. It was network glitch. Please confirm you can hear me clearly and you can see my screen.
Okay. I can see the screen.
And you can also see my screen being shared.
Yes, sir.
All right. For scenario 1,
140,000.
140,000 negative to reduce the amount I've paid. Scenario 2, what do you have?
360,000.
Additional payment to be made. Now, net interest cost. Net interest cost. Let's go up small. I'm trying to have the two together there. Smaller. All right. Go small. Small up. 1,625,000 minus 140. What do you have?
1485.
1,000,000.
485,000.
1,485,000. Scenario 2. 1,125,000 plus 360.
1,485,000.
1,485,000. That is your net interest cost. If you now confirm it to the FRA rates under the FRA agreement, the amount you should have paid under FRA, look at it, your FRA payments, FRA, I should have paid 5.94% multiplied by 50 million multiplied by 6 months. Work that out. It must give you 1,485,000. You must not pay less than this amount, and you must not pay more than this amount, because FRA is a binding hedging instrument. By the time you finish your computation, your the net interest cost must equal to the FRA payment. You are done with requirements A. This was the question. Okay, something like this was tested last time for 20 marks. Any question for me, please?
I have a question, sir.
Yes, please go ahead.
Okay, so the interest cost for both scenarios, we should always arrive at the same answer, right? Or is just a
In as much as you are edging with FRA, your net interest cost must equal to the amount you are going to pay under FRA. It cannot be more than, it cannot be less than, because FRA is a binding hedging instrument. Is that clear, ma'am?
Yes, thank you, sir.
All right, ma'am. Let us move to requirement B quickly. Requirement B. Okay, now it's even here safe, so that we reduce going up and down. Examiner says, compare the use of interest rate futures with FRAs in this circumstance, in this instance. What the examiner is trying to ask is that, assuming you have to use interest rate futures to hedge the transaction, as opposed to using FRA. You know, we have used FRA. Assuming we want to use interest rate futures to protect against our borrowing, how would this work? Look at it. Interest rate futures have the same effect as FRA, in that you are going to be locked into an interest rate. They have the same effect because you are going to lock yourself into a fixed interest rate. However, unlike FRAs, interest rate futures are standardized in terms of size, duration, and terms. When we say standardized, you have standard contract. You can do one contract, standard contract size. You can select one contract, two contracts, three contracts. Unlike FRAs agreements are not standardized. It can accommodate fractions. But futures contracts cannot accommodate fractions. It must be standard contracts. Also, standardized in terms of duration. Futures contracts are for 3-month period. You have March contract, June contract, September contract, and December contract. And in terms, however, they are tradable on exchange. Futures contracts are tradable. francs are not tradable. They are generally closed out prior to maturity with gain or loss. Your futures contracts are closed out before maturity. And you can either make profit or gain. When you make profit, the profit can be used to reduce higher borrowing costs. When you incur loss, your loss will add to your reduced borrowing cost, lower borrowing cost. The markets, futures markets are designed in opposite direction to the money markets. Since the company is planning to borrow money, remember this, a borrower sells futures. A borrower will sell futures. If interest rate rises, value of future will fall. At this market, the borrower will sell futures. If interest rate rises, value of the funds will fall. The borrower cannot buy back. The borrower can then buy back at a reduced price, thereby making profits from the futures market. This profit will be used to reduce the increase in your borrowing cost. When we get to calculation on this hedging, it should get clearer. Then the C part of the question says, explain how interest rate guarantees or short-term interest rate cap can be used. These are theoretical questions. What is interest rate guarantees? How is it different from forward rate agreement? Interest rate guarantees or short-term interest rate caps offer the opportunity to limit the impact of any adverse fluctuation in interest rates. Your interest rate guarantees can be used to limit the impact of any adverse movement in interest rates. At the same time, it allows you to take advantage of favorable movement in exchange in interest rates. Unlike France, interest rate guarantees is an option. Unlike France, interest rate guarantee is an option. They represent interest rate options, giving the holder the right, but not the obligation. This means that if interest rate rises, the option will be exercised. You are going to exercise your guarantee. You are going to use your guarantee to borrow at the guarantee rate if the interest rate rises above the guarantee rate. If the interest rate falls below guarantee rate, you are not going to exercise your guarantee. You are what? You are going to opt out of the option. You can now borrow at a lower interest rate in the market. The two requirements B and C are theoretical questions. And that is why I always try to tell students that you can plan your strategy for this exam. We know as an individual, you know your strengths. If you are struggling with computation, then go and work on your theories very well. What matters is to score 50 and above. I have seen students without answering any calculation, and the guy scored 65, and he qualified. All right. Illustration 2. Let us look at illustration 4. Please refer to illustration 4 on your study pack. Please refer to illustration 4 on your study pack. I'm assuming we are good to go. All right. It is 1st December 2017. Dominion PSC, a global company, plan to purchase machinery from UK supplier on 28 February 2018. The firm's cash flow forecast showed that the firm will need to borrow £4 million on the 28th February for a period of 9 months. Look at that paragraph 1. Today is 1st December 2017. By 28th February 2018, we need to borrow money for 9 months. Between December and February, how many months? Hello, guys.
3 months.
3 months.
3 months. That means in 3 months' time, we are going to borrow money for 9 months. All right. As you read question, pay attention to the dates. Paragraph 2. In just 1 minute. Let's go on. Paragraph 2. The directors are concerned that short-term sterling interest rates may rise between now and the end of February. sterling short-term interest rate futures or traded interest rate options on futures to hedge against the firm's exposure to interest rate rises. At 1st December, spot interest rate is 3% per annum. That is, assuming we are borrowing in December now, the interest rate we are going to pay is 3% per annum. But we are going to borrow in 3 months' time, 28 February. Continuation. March 3-month sterling interest rate futures with a contract size of £500,000 are trading at 96. Information regarding traded interest options on futures in December 1st, 2017 is as follows. You have this strike price. Your strike price is your exercise price. You are given the call options. You have the put options for March, June, September. Premium are in annual percentage. Requirement A. Demonstrate how sterling interest rates sterling short-term interest rate futures can be used by Dominion PSC to hedge against interest rate rises and show the effective loan rate achieved and the hedge efficiency if on 28 February 2018 the spot rate of interest is 5%, 4.5% per annum, and March interest rate futures has fallen to 95. Let us start with A. Please listen attentively and trying to follow. It is not difficult. One thing with this hedging is that it has consistency. Once you can master the consistency, you are fine. What are the steps? I want to hedge with interest rate futures. What are the steps involved? Interest rates, futures, hedging. What are the steps? You have like 5 steps. So if you can try to master the step, you are fine. Step 1, determine the target interest cost. To get that, your target is you want to avoid fluctuation in your interest rates. If you borrow today, assuming we are borrowing on 1st December, you are going to pay 3% as your interest. Assuming you borrow the money on 1st December, you will have paid 3% on your borrowing. So your target interest cost target interest cost is equal to %. That borrowing rate today, you are going to take that borrowing rate for today, multiply by amount you want to borrow, £4 million, and you are going to borrow for 9 months. Please, that will give you your target interest cost. You want to make that if you are borrowing in February, you must not pay more than your target interest cost. That is the purpose of your hedging. That is why you are using interest rate futures hedging. Please compute, what is our target interest cost?
$90,000.
Oh yeah.
90,000.
£90,000. That will be answer in step 1. Your step 2. Calculate number of contracts. Number of contracts needed. To do this, the formula is amount you are planning to borrow £4 million divided by the contract size. If you look at the
Your line is breaking, sir. Or is it only from my end?
No, ma. His line is breaking.
Please confirm you can see my screen being shared.
Confirm, sir.
Confirm.
All right. Calculate number of contracts needed. To do this, amount of loan, amount you plan to borrow, divided by the contract size, multiplied by the length of your borrowing. You are planning to borrow for 9 months, divided by 3. 3 is constant with the formula. Work this. That will give you number of contracts you need. What do we have?
24.
24 contracts. You go to step 3. Step 3. determine whether to buy or sell futures. Now, without wasting time, please log this into your system. A borrower will sell future. A lender will buy futures. If your company is, okay, network is still fluctuating. Let me hold on. If your company is planning to borrow money, then your company is a borrower. In that case, your company will sell futures. In that case, your company will sell what? Futures. If your company is planning to place investments at a future period, in that case, your company is a lender. Your company will buy futures. When you come here, you are going to put the notes. The company needs to sell futures. Now, the company will need to sell futures now. That will take you to step 4. At what price will the company sell futures? That will take you to step 4. Determine the contract expiring date to use. Answer this question. When are we going to borrow money? When will this company borrow money? This company will borrow money on the 28th of February. Therefore, you are going to use that contract that matures after February 28th. Remember, we have 4 contracts. March futures contracts, September futures contracts, June futures contracts, and December futures contracts. Since the transaction date is on the 28th of February, then we are going to make use of March futures contracts. That is the contract that will mature immediately after the transaction date. We make use of March futures contracts with opening futures price. What is the price? Examiner gave you in the question. Look at it. March, 3-month sterling interest rate futures with a contract size of 500,000 are trading at 96. That 96 is in index form. Just pick it. 96. Your step 5. Evaluate your edge result. Evaluate the edge result. Remember, we explained this. Excuse me. We have two separate markets. You have the money market or the cash market, where you are going to borrow your money. You have the hedging market. The hedging market is the futures market, where you are going to hedge the interest rate volatility. Now come here. You start with the cash market. The cash market. What is the actual borrowing rate on that date? At the cash market, actual borrowing rates. Let us go and check. Examiner says if on 28th February, the spot rate of interest is 4.5%. That means on that date, the actual borrowing rate is 4.5%. You pick the rate. .5%. Calculate actual interest cost. Actual interest cost. That is, you are going to borrow at 4.5. You are going to borrow £4 million for 9 months. Please compute actual borrowing cost. Please compute your actual borrowing cost. How much, please? Oh yeah, Minister for Finance. Omawumi. Oh yeah, for me figure.
12. B. Hope I did not make mistakes.
At least we tried.
Let me do it again.
I have to carry my calculator here.
135,000.
So 135,000.
Thank you. In bracket, 135,000. That is your actual borrowing cost, the amount you pay. But your plan is to pay how much? Your target interest cost. Target interest cost. Your plan is to pay 90,000. That means you have overpaid. You have incurred loss. Is that not? At the money market, we have borrowed at an interest rate above our target. Loss at the cash market. The difference?
45,000.
Negative. negative 45,000 pounds because we have overpaid. That is your cash market transaction. You now go to the second market, futures market. At the futures market, you start by selling. Look at this. At the commencement of your hedging, we said borrower will sell futures. Sell. The borrower will sell futures at what price? Examiner says $96. You pick that 96. That is what we call opening future. That is opening. You are going to sell at opening. 96. At closing, at the end of 3 months, you are going to close out. To close out, you are going to do the opposite of what you did at opening. You are not going to buy. At the commencement of your hedging, we said borrower will sell future. At the closing of your hedging, you are going to do the opposite of what you start with. You are going to buy. Now, what is the closing price? Futures price. Look at the question. Examiner says the March interest rate futures price has fallen to what? 95. At the close of March, the futures price has fallen to 95. You now pick it. $95. The difference, look at it. You are selling future for 96. You are buying back for 95. That means you have made a gain. Gain on futures. The difference is 1%. That was what we tried to explain. If you look at here, once you incur loss in the cash market, you must make profit in the futures market. Once you incurred loss in your cash market, you must make profit in the futures market. Calculate the gain in monetary gain. Monetary gain. That becomes 1% of £4 million for 9 months. Please work this out. What is the monetary gain? Convert percentage to monetary gain. How much? That should give us £30,000. Please confirm.
Confirm, sir.
Good. That means in the cash market, you are going to pay On your borrowing, you are going to pay 135,000 pounds. You are now going to make a profit of 30,000 to reduce the actual amount you have paid. Therefore, your net interest cost is equal to, you are going to pay 135,000 then plus 30,000 gain. Your interest cost becomes 105,000. If you pay 135,000, the profit you achieve at the futures market will be used to reduce their actual amount paid. That means your net interest cost is 105. Assuming you have not hedged, you will have paid 135,000 pounds as the interest. Interest rate future. Your interest cost has been reduced to 105,000. If you want to calculate effective loan rate percentage, this interest cost is in naira, is in absolute amount, pounds. If I want to get this amount in percentage form, as an instance says, what is the effective loan rate? Look at the formula. Your net interest cost, you can note it down, net interest cost, that is in absolute value, divided by amount of loan multiplied by 12 months. 12 months we take it for 1 year. We have 12 months in a year. Divided by the length of borrowing. Length of borrowing. That is the formula. If you want to calculate the effective loan rate now, our net interest cost is 105,000. Amount of loan is 4 million. Multiplied by 12. Length of borrowing. The company will borrow for 9 months. Please work this out. That will give you the effective loan rate you are paying. Please work this out.
35%.
Percent. Do you multiply by 100?
No, sorry. 0.035. 0.035.
And now, if you multiply by 100, it should give you 3.5%.
3.5%.
That means instead of borrowing at 4%, 4.5% actual borrowing rate, by hedging using interest rate futures, your borrowing rate has reduced to 3.5%. That is the effective loan rate. Examiner says, look at it. Demonstrate how this can be done. We have demonstrated the effective loan rate achieved, 3.5%, and the hedge efficiency ratio. Your hedge efficiency. Let me calculate that first. What we call hedge efficiency ratio is simply your profits divided by loss. Hedge efficiency ratio is equal to profits over loss multiplied by 100. Remember that we said for interest rate futures, we have two markets. You have the cash market, where company borrow money or place investment. You have the futures market, where company hedge interest rate volatility. And we said these markets are designed in opposite direction. If you make profit in one market, you must incur loss in the other market. If you incur loss in one market, you must make profit in the other market. Look at this question now. We achieved profits of 30,000 naira at the futures market. We incur loss of 45,000 naira at the cash market. 30,000 divided by 45 multiplied by 100. 30,000 profits divided by 45,000 loss multiplied by 100. That will give you 75%. That is the hedge efficiency ratio. That is your hedge efficiency ratio. Along the line, somebody, a student was asking, I think that we should explain. I saw a chart, if I'm not mistaken. We should explain step 2 again.
So this calculation
I
is
saw that chart.
7%, sir.
It can be 7% now. Please check your calculator very well.
67.
Oh, sorry. What do you have?
67%.
67%.
Oh, yeah. Sorry. 66.67%, Abby.
67.
Approximately 67%, right?
Yes, sir.
Confirm.
Oh, okay. Sorry, my error.
Yes.
I was thinking of another question.
Yes, sir.
That is the edge.
Sorry, sir. If I may ask, sir, this step that you've given us now during exams, sir.
Yes, Yusuf. This step that we are following. Take it from there.
Yes, if I may ask, can we label it the way you've labeled it for us in the exam, or we should just go directly to calculate all those things?
Okay. Okay. First is to be on a safe side, you can just label step 1, step 2, step 3. If you are not used to it very well, when you are just learning something, if you are very used to it very well now, you cannot just be say, okay, 1, I want to do this. That is first thing. Second thing is that I plan to say is that at times you might not need to go through the steps, depending on the nature, how the question is framed. For example, if you are not asked to calculate edge efficiency ratio, then you might not do profit or loss. You might not need absolute value. You can just use percentage only. If you are not asked to calculate edge efficiency ratio, you might not require the absolute value. But like I said, I want to take it gradual, so that when I get to some questions, I will now explain why we are now following this pattern. So you can try to study this first, so that when you get used to it, because some questions you might not be asked to calculate edge efficiency ratio. Now in this question, we are giving the opening futures price at the commencement of the hedging. Examiner says futures price is 96. At the closing of the hedging, examiner says futures price has fallen to 95. Some question, examiner will only give you opening futures price. It will not give you closing futures price. That means you might need to adjust a bit. So, in summary, let us take the step first. Particularly once you are asked to calculate edge efficiency ratio, you must follow the step. Is that better, Yusuf?
Yes, sir. Thank you so much, sir. Thank you. I understand, sir.
Now, for the question on step 2, it is just to calculate number of contracts. And we explained the formula last week. To calculate number of contracts, the formula is, let me show it here. So that the formula is amount of loan over contract size multiplied by the length of the loan divided by 3. Like I explained, all contracts are for 3-month period under interest rate futures. You can please take this formula down. We are done with requirements A. Now let's look at requirement B. Requirement B. Examiner says demonstrate out-traded interest rate option on futures can be used by DP, Dominion PSC, to hedge the interest rate, to hedge against interest rate rising above 3.75% and show the effective loan rate achieved. If on the 28th, the spot rate happens to be 4.4% per annum, and the futures price is 95.31. For every decision we make in life, there's element of risk. We can only try to use the best network in our individual areas. Every decision, every business we have to just appeal to MTN. In fact, they know that the way I use their network. All right, please confirm you can hear me clearly and you can see my screen. Please confirm that you can hear me clearly.
Confirm, sir.
And you can see my screen.
We can, sir. 100.
All right. We are trying to explain that requirement B demonstrates how traded interest rate option on futures can be used by Dominion PSC to hedge against interest rate rising above 3.5% and show the effective loan rate achieved. If on 28 February 2018, spot interest rate is 4.45%, 4.4%, and futures price is 93. From figure 1. From figure 2. The spot price is 2.1%. and futures price is 97.75. All right. We want to use traded interest rate options now. What are the steps to be taken? Let us follow the step. Requirement B. Traded interest rate option. Step 1. Do we require call or put option? Question mark. Without wasting time, a borrower will buy put option. If your company is planning to borrow money and you want to use options on interest rate future, interest rates, we call it options on interest rate futures. The borrower will buy put option, while the lender will buy call option. For this particular question, the company in question is planning to borrow money. In this case, we are going to state it. The company we need to buy put option contracts. That answer your step 1. And that is very compulsory to do it. Because the premium payable under call is different from the premium payable under put. If you fail to select the appropriate contract, that person will miss the point. Step 2. Calculate number of contracts needed. Calculate number of contract needed. The same thing we did. Amount of the loan, 4 million. Contract size, 500,000. Length of borrow in 9 months. Then divided by 3. This is 24 contracts. The same thing we did in interest rate option. Step 3. Determine the contract expiring dates to use. The same thing we answer under interest rate futures. The transaction date is on the 28th of February. Which contract will mature after February? We make use of March. Now, March put option contracts. Which put option contract are we going to buy? Look at the question. You are given 3. Look at it. We have agreed that for this transaction, we require put. You have put option for March, put option for June, put option for September. So determine the contract expiring date to use. You now answer yourself. The company will borrow on the 28th of March. Which contract will expire immediately after 28? March futures contract. Now come here. Yes. We make use of March put option contracts. What is the price for March? Let's go and check. Aha, the price. Where is the question? We have three prices. Look at it. Strike price, 96.25, 96.50, 96.75. Three prices for March. Which of the prices are we going to select now? That will take you to step 4. Step 4. Determine the exercise price. The exercise price to select. This will happen if you are giving one-month exercise prices. Which exercise price are we going to use? Please note, strike price is the same as exercise price. We now go to the question. Examiner gave us a pointer. Look at it, please. Demonstrates how traded interest rate options on futures can be used by DP to hedge against the interest rate rising above 3.75%. We are ready to pay 3.75, but it must not go above 3.75. You now go and check. We have three exercise prices. We have the strike price. Examiner says 96.25, 96.50, 96.75. If you want to take this to interest, this is what we call index form. If I want to get the interest rates here, implied, we call it implied interest rate. 100 minus 96.25. Please work that out. 100 minus 96.50. 100 minus 96.75. Please work this out. 3.75%. 3.50%. 3.25%. I hope I'm correct. I hope I'm correct. Oh.
Correct, sir.
Which of these exercise prices meet our criteria? We exactly meet our criteria, our desire here. Our target is to work towards 3.75 maximum. That means we are going to select 96.25. Examiner says to protect against interest rate rising above 3.75%. The company is ready to pay 3.75 maximum. It must not go above this. When you are done with this, you now come to your step 5. Your step 5, final step. Evaluate the edge results. Evaluate the edge results. Evaluate your edge results. Remember, you have 2 markets. You have the cash market. In this question, we have 2 scenarios. For requirement B, you have 2 scenarios. Scenario 1 and scenario 2. You have your cash market. Your cash market is where you are going to borrow money. Your cash market. That is the money market. Examiner says if on 28 February, the spot rate is 4.4%. Scenario 1. Future is this. I'll come back to this. Scenario 2. Spot rate is 2.1%. That is the actual borrowing rate. Now come here. Okay. For conveniency, let me start with future markets. It's just for conveniency. I will come back to the cash market. For conveniency, the futures market. Our implied exercise price. Implied exercise price. That is the interest rate. Look at it. Look at it, please. Implied rate 3 at 96.25. The interest rate is 3.75. Pick that. Implied exercise price, or we can call it interest. This is, please allow me to take this off. It's coming to an implied interest rates at 96.25. That gave us 3.75%. 3.75%. That is the exercise rate. Now, scenario 1 says, at the futures market, the futures price is 95.31 or 97.75. I'll come here. For the first scenario, please look at it. For the first scenario, the futures price happens to be 95.31. If I want to convert to interest rates, 100 minus 95.31. Please work this out. What is the implied interest rate? This scenario 1.
4.69.
4.69%. Thank you. For second scenario, the futures price is 97.75. Is that not? In percentage, what is the percentage here?
2.25.
2.25. Thank you, sir. We now do like this. We are still dealing with the futures market. We call it option on futures. Let me use that word. Options on futures. Options on futures markets. Better. Now, I don't put this yet. Need to answer yes or no. You have a choice. You have a choice. Look at this scenario. You have a choice to borrow at 3.75 or borrow at 4.69. Which one is better for you? Hello.
3.75.
That means you are going to exercise your rights. You know, the exercise rate is 3.75. Here you are going to put exercise or not. Question mark. Here you are going to pick yes. If you borrow at 3.75 as opposed to 4.69, 0.69. You are going to make a profit. The difference, profit on option, 0.94%. Look at the second scenario. Your exercise borrowing rate is 3.75. But you have option to take 2.25. What are you going to do here?
No, it's a loss.
No. You are not going to exercise your rights. You are going to opt out of the option contract. For the second scenario, you are not going to exercise your rights. You are going to opt out. You are not going to incur loss. Neither are you going to make profit. Opt out. You now come here. Actual spot rates. On that day, actual spot interest rates for scenario 1, that is for, because it's borrowing rates. Because it's a borrowing rate, it will be in brackets. For scenario 2, actual spot borrowing rate, 2.1. Your premium, the premium payable. What is the premium payable for March? For the selected price. Look at the premium. You have selected exercise price of 96.25. Your premium is 0.18%. Premium is an expense. You come here. The premium must be paid, whether you exercise your rights or not. Premium here, payment, 0.18%. Here, 0.18%. You can calculate your rate now. Here you have 0. Positive here. Positive 0.49, negative 4.4, negative 0.81. Please work this out. That will give you the effective low rate. Work this out, work this out. This should give me 2.28%. How much here? Three point what?
64.
3.64%. If you look at the two scenarios, it's still within the company's plan. Our borrowing rate must not exceed 3.75%. Done. You are done with the edging. The borrowing rate must not exceed 3.75. That is the reason why the company is hedging. Please carefully study this. We have shown the effective loan rates. Please carefully study this. Any question? While we look at requirement C.
Sir, what about the cash market?
You have picked the cash market. Okay, as I do. The cash market, this is the actual amount. Okay, let me go and label it that. What happened at the cash market is your actual borrowing rate. Okay, let me quickly show that also. You are right, that can actually, this is the cash market transaction. Cash market. That is where you are going to bring the actual borrowing rate in. What happens in the cash market is only your actual borrowing rate. Your actual borrowing rate plus the premium you paid, then less the profit you achieve on option. Oh, excuse me, please. So please, carefully study this. We are still meeting next week. I'm sure of that by God's grace. And I'm still going to take question on this interest rate hedging. Although, you know, from the, if you look at it, it's like, oh, they text it because it was tested last days. But again, let's just treat the topic. How the examiner will navigate, we don't know. So we must try to reduce that laziness. Requirement C. Explain why a hedge using futures contracts may be less than 100% efficient. The reason is not far-fetched. The reason why our hedging is not efficient Look at this computation here. This is not 100%. The reason is because of basis. Let me put it here. Number has reduced to 12. Started with 19 students. All right. Right. Because of the existence of bases, at the commencement of edging, the spot interest rates is not the same as the futures, it's not the same as the opening futures price. Opening futures price. The existence of basis. The existence of basis makes the edging to be less efficient. That is the expected response. That is the expected what? Response. We are done with the question. Any question, comments, or what have you? My only advice is that try to study it. One question will be texted from edging. Definitely in your exam, One question will be texted from the edging. Examiner may take option theory or currency, foreign currency hedging or interest rate hedging. Between these three topics, 20 marks will be texted. The choice is now for individual to work with the information. Just like your compulsory question. It's usually between investments, business valuation, merger and acquisition, or cost of capital. All these four topics will be mixed together in your number one question. Examiner will mix all of them together. In that number one, you are going to treat cost of capital. In that number one, your knowledge of investment analysis will be required. In that number one, your knowledge of business valuation or bond valuation will be needed. Examiner will come with a question that will cover like 5 topics. It is left for individual students to know how to work with the information. All right? Any question for me? If there's no question, I will be stepping out of the classroom.